What if the biggest investing mistake in America right now isn't buying the wrong stock, but buying the most popular one? Think about it. Every day, millions of investors automatically pour money into the S&P 500 because they've been told it's the safest long-term investment ever created. And to be fair, for decades that advice worked incredibly well. But what if the market is quietly changing while almost nobody is paying attention? What if the next generation of wealth isn't hiding inside the companies everyone already owns? Here's something that should make every investor stop and think. In 2026, the Russell 2000, an index made up of roughly 2,000 smaller American companies, has climbed around 22%, while the S&P 500 has gained only about 7.5%. That's not just a good year for small caps, it's the biggest performance gap in more than 20 years. So why is almost nobody talking about it? The answer becomes even more interesting when you look at valuation. Right now, the S&P 500 is trading near one of the most expensive levels in modern financial history. The Buffett Indicator, which compares the total value of the U.S. stock market to the country's GDP, recently climbed above 219%. The Shiller CAPE Ratio, one of Wall Street's favorite long-term valuation tools, is hovering around 41, a level only seen during the dot-com bubble. History doesn't guarantee the future, but it leaves clues. And those clues tell us that when investors pay extremely high prices for great companies, future returns often become much lower than expected. This isn't about predicting a crash next month. Markets can stay expensive longer than anyone expects. But over the next 10 years, starting valuation has repeatedly proven to be one of the strongest predictors of investment returns. We've seen this story before. At the peak of the dot-com bubble in 2000, investors believed large technology companies could only keep going higher. Instead, the S&P 500 spent years delivering disappointing returns. Meanwhile, smaller companies quietly outperformed because they started from much cheaper prices. That's the lesson most investors forget. Great investments don't always begin with exciting headlines. They often begin when nobody is paying attention. Fast forward to today, and the similarities are difficult to ignore. Large-cap technology stocks dominate financial news, while many smaller businesses continue trading at significant discounts. Money has already started rotating away from the market's biggest winners and into overlooked companies with lower valuations. Could this be the beginning of another long cycle where small caps outperform? Nobody can say with certainty. But history suggests investors should at least pay attention. Of course, there is an important risk. Small-cap stocks are naturally more volatile than large-cap companies. During economic uncertainty, they can fall much faster and experience deeper drawdowns. That's why trying to perfectly time the market rarely works. Instead, experienced investors often rely on one simple strategy: dollar-cost averaging. They invest the same amount every month, regardless of whether markets are rising or falling. When prices decline, they automatically buy more shares. When prices rise, they continue investing without chasing momentum. Over years, this simple habit removes emotion, reduces stress, and allows compounding to work its magic. It's not exciting, but history shows that consistency often beats prediction. So, if I were building a portfolio from scratch today with fresh capital and a long investment horizon, I'd take a very serious look at the Russell 2000. Not because it's guaranteed to outperform, not because it can't experience painful declines, but because history has repeatedly rewarded investors willing to buy quality assets before they become the center of attention. The biggest fortunes are rarely built by following the crowd after everyone agrees. They're built by recognizing opportunity while most people are still looking somewhere else. So, here's the question that matters most. 10 years from now, will investors look back at 2026 as the moment small-cap stocks quietly began leading the market once again? Or will they realize the opportunity only after the biggest gains have already happened? Nobody knows the future. But history reminds us of one timeless truth. Wealth is rarely created by chasing popularity. It's created by buying value, staying disciplined, and giving time the chance to do what it has always done: reward patient investors.